Hello everybody, I'm Rishad Salamat. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, gold has been on a tear while the dollar, the world's reserve currency, is under pressure. Is this just market volatility or a sign of a shifting global confidence in American assets? India is at the center of a shifting global trade landscape. It has recently reached deals with the United States and the EU. Is New Delhi increasing its global leverage or simply managing its risks? Dubbed the world's safety net, the United Nations says it's running out of money. Why are countries not paying their dues? And what happens when the guardians of the global order goes broke? It is the backbone of global growth. The American economy and markets are unmatched in size. The dollar is the king of currencies, and U.S. treasuries are often considered safe haven assets. But investors appear to be reassessing that. That's been weighing down the greenback and cooling down other markets. But big winners, though, have been gold and silver, which both recently hit record high prices, exactly what the metals tend to do in times of uncertainty. Moves in the price of the greenback ripple across the global economy. Oil is priced in it, trade flows depend on it, and central banks hold it in reserves. So, are investors turning away from American assets towards havens like gold? And what would that mean for the global economy? Felix Niwara reports.
The dollar is our currency, but your problem. Washington uttered these famous words to the rest of the world in the 70s as it dropped the gold standard. The US dollar has been the world's #1 reserve currency for decades. And when its value shifts, the effects ripple through other economies, commodity markets, and global policies. But the greenback's value has been going down. It lost around 10% against a basket of global currencies in the past year, its worst annual performance since 2017. But President Donald Trump isn't worried about that.
Dollar's doing great. You know, it's very interesting. If you look at China and Japan, I used to fight like hell with them because they always wanted to devalue their yen. You know that? The yen and the yuan. And they'd always want to devalue it. They devalue. And I said, not fair that you devalue because it's hard to compete when they devalue. But they always fought, no, our dollar's very good.
Trump is seen to be favoring a weaker dollar because it means US exports become cheaper to buy and more competitive. But it could reduce purchasing power for Americans and risks fueling inflation. Many economists say this approach and Trump's tariff threats have hurt American consumers and pushed investors to look for safe havens, reducing exposure to US assets.
The unpredictability of US policy has dented the US dollar as the global safe asset. There's not a lot of great alternatives, so I think that has a lot to do with the depreciation of the US dollar and has a lot to do with the dramatic increase you've seen in the price of gold.
When Trump won the election, interest rates were around 5%. After several cuts, they are now more than a percentage point lower. Lower rates mean a lower drive to store money in US Treasury bills because the returns they offer becomes less. Trump has been pushing for even lower rates to help stimulate the economy, a request the Fed's next chairman would have to endure.
I don't want to ask him that question. I think it's inappropriate, probably would be allowed, but I want to keep it nice and pure. But he certainly wants to cut rates. I've been watching him for a long time.
Trump's gripe with the Fed has left investors worried the US central bank could lose its independence. Yet another reason for them to look elsewhere, away from the dollar. Felix Niwara, Al Jazeera, for Counting the Cost.
So where are investors looking to put their money at a time of turmoil? The answer? Gold. Over the first year of Donald Trump's presidency, a troy ounce of gold has almost doubled. In April, Trump announced his trade tariff wars, causing investors to sell stocks and buy the precious metal. Then, throughout the year, geopolitical tensions and ongoing conflicts in the Middle East, Ukraine, South and Southeast Asia all increased demand for gold. By the end of January, prices reached highs of around $5,500 per ounce. The dollar's decline also makes anything traded in dollars increase in price. The price of gold has fluctuated since then. It's not just the pressure on the dollar's value that has sent gold prices soaring. And to discuss all of that, we're joined by Bilal Hafiz. He's the founder and CEO of Macro Hive. That's a global macroeconomic research and strategy firm. And he joins us now from London. Bilal, with the dollar, the greenback hitting these four-year lows last week. Why?
Well, I think a few different reasons. One has been there's been a huge amount of uncertainty around US policy, both in terms of trade policy, geopolitics, and so on. So that's always been weighing on the dollar. Earlier this year, we had lots of geopolitical concerns which hit the dollar. Second is there's a speculation around the Fed. The Fed started to resume its easing cycle in the final quarter of last year, and there's much more focus that they're going to cut rates a lot more this year. And then also we have seen some kind of indirect intervention by the Japanese to strengthen their currency and weaken the dollar. So all of these factors have come together to see the dollar weaken, and I think there's more to go.
So tell me something, is this genuine dollar debasement or a crisis of confidence ultimately?
I think at this stage, I don't think it's this debasement per se. I think at the moment, a lot of this is just investor flow shifting away from the US, looking at other markets which could be attractive. I think that there is this concern around the demand for the dollar from institutions around the world in terms of what reserves they should hold. So there is some element of that. But at this stage, given how broader markets in the US have behaved, it's unclear whether this is a true debasement trade.
Exactly, and just adding to what you just said, the so-called BRICS nations have been looking to perhaps have another reserve currency at the very maximum, but also trade outside of the dollar system. Is that actually possible?
I think it is, of course, possible, but it's very hard to do. For many, many years, the Chinese have tried to build up a parallel system outside of the dollar system. And it's been very difficult for them to get other countries to use the renminbi settlement system. It's really only Chinese trade that uses it. The Europeans haven't been as willing to do much on that side either. So it takes years and years and decades to build up the dollar system. And so while there is interest in finding alternatives, it's very hard to displace the dollar system. And I think for that reason, at this stage, I don't think there is a viable alternative.
Bilal, one famous commentator said the weak dollar does not tell us the weather. It is actually a barometer. So if it's a barometer, is it reflecting perhaps a hedging strategy as we see people going into gold and silver?
Yes, I think that's a large part of it. It's a hedging strategy for people to find some kind of market that is the market that will do well in multiple different scenarios, and gold ticks the boxes there. You know, people are worried about the dollar, gold will do well. If people are worried about inflation, gold will do well also. At the same time, I think also there is a question of relative dynamics between different regions. So there's been a lot of optimism around US growth for the last 10, 20 years. People are worried about US growth now. So maybe people are thinking, okay, let's shift over towards other parts of the world as well. So some of this is also about where investment flow should go.
And indeed, Donald Trump is on record saying that he wants a weaker dollar. Should he be careful for what he wishes for?
Yes, perhaps he should be. But I think at this stage, what we have seen is that many countries have pursued a weak currency policy. The Japanese have, the Chinese have. And the reason they do that is because they have very dominant manufacturing sectors that export a lot. And the US and the Trump administration in particular, really does want to onshore manufacturing to the US. And I think his view is, as part of that whole package, you need a weak currency as well. So that's kind of the good reason to have a weak dollar. The problem will be is if the dollar was to fall too quickly, then there'll be this question of debasement. Then there could be a knock-on effect on the bond markets and interest rates go up and so on. That's what they don't want.
Well, that's it, isn't it, Bilal? I mean, if you have a weaker dollar and you've got a trade deficit of the size that the Americans run, you've got the spectre of inflation and therefore the much vaunted goal by Donald Trump to lower interest rate, that's gone.
Absolutely. So this is the dilemma they have, you know, and they've got to thread this needle in terms of trying to balance all of these competing forces. At the same time, we have to also recognize that the US labor market is weak right now. So there is a problem there that they need to stimulate growth to some extent to stabilize the labor market. At this stage, if you look at inflation markets, they aren't saying that markets are that worried about US inflation. So there's competing demands, and this is, this will be an ongoing challenge for the US in terms of balancing these different factors.
Now, on the other side of this trade, as it were, you've got gold and silver, of course, going up exponentially. Of course, they've come off of late. But does that warn of a deeper set crisis in a way?
I think that at this stage, I would say no, it doesn't. And the reason I say that is because it's been a fairly isolated move, because we've seen this, huge move up in gold. At the same time, we've seen US equity markets do incredibly well, especially AI and tech stocks. And if we look at credit markets in the US and elsewhere, they behaved really, really well. So the fact that it's just gold by itself and not these other markets, that makes me think that this is more of a kind of a precious metal story that's going on, rather than a sign of something much bigger.
So do you see the likes of these precious metals continuing to go up?
I think they will. I mean, obviously the pace of their moves has been so rapid. There will be some consolidation, as we've seen at periods of this year. But over the medium term, I think they will continue to go up. And one reason is that central banks around the world are trying to find alternatives to the dollar, and gold is one of the easiest ones to allocate to. And the gold market is relatively small, so there's this supply-demand imbalance. What we're also seeing is that investors in general around the world, institutional investors, have generally been underweight gold, and so they're having to catch up to these price moves. So I think there's enough dynamics here for it to propel gold to further highs.
Bilal, always a pleasure, never a chore. Bilal Hafiz there from Macro Highway. He's the CEO joining us from London. Well, India is placing its bets, and the stakes couldn't be higher. It wants to become a global manufacturing hub, an alternative to China, but it has come under pressure from high US tariffs. Now the country is trying to cement its role in a changing trade landscape, expanding its trade ties on multiple fronts. This includes a deal with Washington to slash tariffs on Indian goods. However, the agreement carries a geopolitical catch, a promise to stop buying Russian oil. And it comes less than a week after New Delhi reached a landmark agreement with the EU, hailed as the mother of all trade deals. Paul Ging reports.
India's been working hard to transform its trading relationships after years of protectionism. Deals have come thick and fast, including with the UK and Oman.
We did it. We delivered the mother of all deals.
This was quickly followed by a trade deal announced with the European Union that had been 20 years in the making.
Friends, we are seeing a lot of turmoil today in the global order. At such a time, the partnership between India and the European Union will strengthen stability in international systems.
Within days, that's now been followed by a trade agreement with the US, which will see tariffs on Indian exports lowered to 18% from 50%. Announcing the deal in a Truth Social post, US President Donald Trump wrote that Modi had agreed to stop buying Russian oil and to buy much more from the United States and potentially Venezuela. Trump also wrote that the Prime Minister had also committed to buy American at a much higher level, in addition to more than $500 billion of US energy, technology, agricultural, coal and many other products. While many specific details of the Indian-US deal are yet to be fully hashed out, in contrast with the detailed one with the EU, India's manufacturing sector is seen as a major potential beneficiary. India's exports in this area include textiles, clothing, leather, jewellery, toys and furniture. Producers are hoping they'll now have an opportunity to regain ground lost to key manufacturing competitors in the region. India's Sensex index, a benchmark for the country's stock market, has reacted positively.
So we saw Sensex going up by 2,300 points. Welcome move. What we have achieved is that we have done deal with UK, we've done deal with EU, now with US, and in the time to come, many more.
But that expansion of Indian exports is apparently contingent on a contraction of one crucial import, oil. India needs to stop buying crude from its traditionally strong ally, Russia.
India currently relies on Russia for over a third of its oil imports, a massive increase from just 2.5%. That was the level before Moscow invaded Ukraine in February 2022. Only in December did Putin and Modi meet in New Delhi, discussing, amongst other issues, their Russia-India Economic Cooperation Programme. Pleasing new partners without alienating traditional ones will require a difficult balancing act. How successful India will be with that remains to be seen. Paul Ging, Al Jazeera, for Counting the Cost.
In New Delhi, we're joined by Biswajit Dar, former professor at the Jawaharlal Nehru University. Biswajit, thank you so much for joining us. Is this EU-India deal really the mother of them all? It's seen as good politics, but what about the economics?
Well, in terms of the economics, of course, India would have access to a very large market in a number of manufacturing sectors, as was mentioned in the in the discussion earlier. That apart from the labor-intensive sectors like textiles and clothing, gems and jewelry, leather, there are also opportunities for pharmaceuticals and possibly mobile phones, because all these electronic goods have become the driver of Indian exports over the past few years. So currently, a lot of these exports are going to the US. But now when tariffs in the EU have come down, there's also opportunity for Indian businesses to expand their footprint in these sectors in the EU as well.
Biswajit, what were the concessions that had to be made? The most contentious points which had to be sorted out here very quickly.
No, the major issue, of course, is always agriculture, because EU was also demanding part of India's agriculture market. And as you know, that Indian government has been very insistent that agriculture can't be opened up because of the presence of a very large number of small farmers who can't stand import competition. Now, in case of the EU-India deal, the agricultural products, the value-added products, the market has been opened up. So food processing sector has been opened up, as has been the wines and several others. Now that has to be seen, because Indian government has had the ambition of making the country a food processing hub. Now, whether the small businesses here in food processing sector can stand up to the competition from these big companies in the EU, that has to be seen.
Yeah, with all that in mind, and what you mentioned earlier, these have been talks with the EU were going on for years. Was the whole spectre of Donald Trump and his, let's say, irregular approach to global economics, i.e. tariffs, the real impetus, the catalyst which made this come to fruition?
No, I have no doubt that the hidden hand of Donald Trump was very much there in clinching this deal, because, as you said, that for the past 2 decades, India and the EU have been engaged in these trade negotiations, and these were going nowhere. And suddenly the momentum, this negotiations got a momentum in 2025. And by the beginning of this year, we already have a deal. So I have no doubt that, of course, Donald Trump's hidden hand is there. And also, the fact that both EU and India need to diversify their export market. They need to look beyond the US. Both of them are, both these countries are really dependent on the US, and therefore the deal.
Okay, let's move from the mother of trade deals to the one that one Indian politician called the father of all trade deals. And we're talking about the US here. Now, it seems that details are scant. What we do know is 18% tariffs on Indian exports. That's a market decrease, and none, though, on US ones here as well. Now, that seems asymmetrical. Also, we have Donald Trump saying that India will double the amount that they will buy in goods terms to $100 billion. Can they do this?
Yeah, I think this is what we know. There's been no confirmation from the government of India. All that we know is a tweet from Donald Trump and also another tweet from the US Secretary of Agriculture, who said that US agricultural products will now be exported to India, and is going to hugely benefit American farmers. So that's what we know. And there's been a lot of unease over the fact that Indian agriculture market is going to be opened up to the US. Apart from the fact that this looks like a pretty asymmetric deal.
Mr. Wajid, I mean, one of the key things here is that Donald Trump is demanding that India give up buying Russian oil. Now, surely New Delhi will protect its traditional ties with Moscow.
Sure. I think India actually reaped a huge benefit by importing Russian oil. Remember, it came at a time when we started increased our oil imports from Russia at a time when the reset after the COVID crisis was going on. And while most countries were facing the inflationary pressures, India got oil at a discount from Russia up to almost up to 25%, and that came very handy in managing its macroeconomic reset. So it was hugely beneficial. Now, once India goes and starts buying oil from the Western Hemisphere, and prices are going to be considerably higher, I really wonder how the Indian government is going to get the macroeconomic right.
Ms. Wajid, thank you so much for joining us. Ms. Wajid Dar, Professor at the Council for Social Development there in New Delhi.
My pleasure. Thank you very much.
Under severe financial strain, the United Nations is warning of a race to bankruptcy with billions of dollars in annual dues still unpaid. The world body is struggling to maintain its humanitarian and peacekeeping missions. The crisis has been accelerated by a pivot in the US, its biggest donor. Washington has questioned the value and efficiency of the UN, the very institution it once helped to build, and has pulled back from dozens of international organizations, including several UN agencies. The annual dues that UN member states pay are set according to factors such as GDP and debt. Although more than 150 member states paid their dues last year, the UN still ended 2025 with a record shortfall of more than $2 billion. The US is responsible for about 95% of the money owed to the United Nations, and that's a combination of the US's annual dues for last year, which haven't been paid, and for 2026. Venezuela has the second largest amount at $38 million for 2025. The UN says it's not expecting a payment from Caracas because of sanctions. Mexico is third, owing some $20 million for 2025. The UN saying that only 36 of its 193 member states have fully paid their 2026 contributions. Now we're joined in Rome by Bodo Elmers. Bodo is the Director of Financing for Sustainable Development Programme at the Global Policy Forum. Bodo, the question is, why are member states not paying?
Well, in very few cases, it's actually a shortage of funds. The largest, or the notorious non-payers are actually among the world's largest and most powerful economies, especially, of course, the USA, but also China, who's paying very late. The shortfall, which comes due to the lack of US funding, is very severe for the United Nations. USA and China is about 40% of the UN's core budget. And well, the reason why they do it is, of course, because they want to put political pressure on the UN. They want to steer the UN's work into a certain direction. This is undermining the role, the nature of the UN as a multilateral organization that serves the international community as a whole. And then in the case of the USA, I think it's probably also that they actually want to weaken the United Nations, that there's not much belief by the Trump administration that the UN is doing such a great job for the USA.
But I mean, how serious is this funding shortfall, and what are the consequences of it?
It's very serious. I mean, the UN Secretariat has to reduce the budget by 15% this year. They have to reduce the workforce by 2,600 staff. That means, of course, that the UN Secretariat can no longer support the mandates, the international negotiations that the UN is supposed to convene. I mean, the UN is the main multilateral body where all nations have a seat at the table. It's the only body, the international body for inclusive multilateral governance. I mean, it competes with bodies like the G7, the G20, but these are exclusive bodies. So especially for the countries of the global south, for developing countries, the UN is extremely important, and the UN Secretariat now lacks the capacity to support all these processes. This is one thing, the political role of the UN. But then, of course, I mean, the many UN agencies like the World Food Programme, the World Health Organization, they provide life-saving assistance to millions of people all over the world, especially in conflict regions. And due to the cuts, the World Health Organization already had to report that 6,000 health centers had to be shut down or reduce their work, depriving millions of people of health supplies. So actually, I mean, these cuts mean that people are going to die.
But what reforms could really be enacted to make the United Nations less economically fragile?
Well, that's a difficult question. I mean, the UN is very dependent on cash contributions by its member states. Other international organizations, like for instance, the World Bank, can borrow on financial markets, or the IMF is just, the International Monetary Fund is just funded by the interest rate revenue it receives from loans given to the member states. So the UN is very dependent to collect cash on an annual basis. There are proposals for reform. For instance, I mean, a very a mild proposal simply that the other member states could step in and cover the shortfalls by the bad payers. This is, of course, a political issue. They don't want to, because, I mean, everyone should pay their dues, the membership fee. But then, of course, I mean, the one solution could be that the UN can access financial markets. This is probably also only a sort of bridge funding, because, of course, if you take out loans, you have to repay them at some point. So it's only to bridge liquidity shortfalls until, let's say, a new government comes in an important UN member states and restores funding for the United Nations. Or, of course, I mean, there are also more ambitious ideas, which is that the UN could have its own resources, like raise international taxes, for instance, on maritime transport or on financial transactions.
Now, Bodo, I mean, from what you've been saying overall, I mean, you can draw the strings together, if you will, and it would perhaps reflect that this financial crisis is partly down to a loss of faith in multilateralism. What do you think of that?
It depends on the country. I mean, there's certainly a loss of faith in multilateralism, or at least in the way of rules-based, fully inclusive multilateralism by the current US administration. But on the other hand, I mean, the UN is operating quite well without the USA in many multilateral processes. For instance, we have currently negotiations on the United Nations Tax Convention ongoing in New York. It's a very important process, especially for African countries who want a new allocation of taxing rights. And this process works. The United States are not participating, but the other member states come together and they continue negotiating. The same happened last year in Spain. We had a very successful United Nations Conference on Financing for Development. So at the moment we have, well, you could say multilateralism -1. So we have, I mean, the international community continues to cooperate well, but the USA is not participating, at least not in this fully inclusive way of multilateralism. But, well, we might see what happens in the future. I mean, the experience with the USA and the United Nations is that there's a lot of back and forth and in and out. And we might see if the US is back at some point of time.
Bodo, thank you so much. Bodo Elmers, Director of the Financing for Sustainable Development Program at the Global Policy Forum.
Thank you for having me.
And that's our show for this week. Get in touch with us on X. I'm at Rishad TV, and do use the hashtag AJCTC when you do, or drop us an email. countingthecost@aljazeera.net is our address. But there's more for you online at aljazeera.com/CTC. That'll take you straight to our page, which has individual reports, links, and entire episodes for you to catch up on. Well, that is it for this edition of Counting the Cost. I'm Rishad Salamat, and from the whole team, thank you so much for joining us. The news on Al Jazeera is next.